Welcome to your Retirement Playbook. Hi, I'm Joe Clark, certified financial planner and the managing partner of the Financial Enhancement Group. This is my opinion, and it is paid content. I own it so that we can distribute it in multiple formats. You are going to share with me the next hour, understanding and discussing what we call a financial journey, the 5 critical elements of financial planning, what most people would call retirement, tax, investment, the risk management, and the estate planning. We've got different names for them because we think there's a whole lot more involved. You're going to learn about your life after work. Yes, yours. You're unique. Secondly, you're going to learn about an annual tax plan, not tax preparation, things you need to do before the end of the year. We're going to discuss an investment playbook. What happens when this happens? Fourth, we're going to talk about life happens. It's the good and bad and the ugly of life. And last, leaving a legacy. It's more than just leaving behind money. Now, if you've been listening to financial programming for a long time, you'll know this show is more than 25 years old with different names along the way. It was the Big Joe Money Show, and then it was the Consider This program. I changed it because of the world of technology to your Retirement Playbook to better comply with what goes on in social media. The content, folks, has not changed. Like I said, the Financial Enhancement Group owns this information. It is educational. It is opinion-based, but realize that things do change from time to time. I was fortunate enough to be able to teach 14 semesters at Purdue University. As an adjunct professor, I taught financial planning, and I had this 240-page textbook that they wanted me to teach out of. Folks, it didn't work. I went to the CFP board. I went to Purdue. I was able to create my own curriculum for that class. It was the capstone course where I broke it down into those 5 critical elements that we talked about, helped people understand a financial journey. But even with it being my content, each semester I had to correct myself at least one time, at least once. And that's because things change, whether it be economic, regulatory, whether it just be new opportunities that's out there. I had to say, hey, this was true at the beginning of the semester. It's not true now. The IRS is always at it, as you know. So things change. We have to be aware of that. Now, we partner with World Equity Group. They're our broker-dealer. They're FINRA and SIPC members of that area. We are not related firms. So when we talk, we are fiduciaries at the Financial Enhancement Group. We're registered investment advisors. We manage, at the time of this recording, more than $600 million. But we also have securities licenses that are out there to help you with products that have been purchased before you got to the Financial Enhancement Group. That's where our relationship with World Equity Group comes into play. They're out of Chicago, and we use them as a partnership in taking care of products that have been sold to you in the past. At the Financial Enhancement Group, we don't sell products. That's not what we do. We're fiduciaries. By law, it is our job to treat your money as if it were our money and we were in your situation or a very similar situation. We're going to talk about Your Life After Work. That's our website, by the way, yourlifeafterwork.com. You can go there to ask us questions for this show. You can go there to get signed up for the Market Carver, our weekly newspaper column, Elements in Focus, where we provide more video throughout the week. Just let us know that you're there. We're happy to have you a part of this show. We hope that we can spend some time and help you construct your financial vision. We're going to invite you to sign up for a Next Steps meeting. It's 90 minutes. It's complimentary. We'll give you things that you're going to want to consider, things you're going to want to consider in your future, and if we choose to partner together, things that the Financial Enhancement Group will do for you, and we'll put it into writing. We just ask that you go to yourlifeafterwork.com or give us a call at 800-928-4001 and get signed up for your Next Steps meeting. Folks, I hope you enjoy the show. We are ready to roll. Let's have some fun talking about your financial journey. How did that wind up in your portfolio? You know, I don't care how many years it's been. Barb and I have been married for 34 years, and when we meet new couples, they always invariably ask one question: how did you meet? We're going to spend the next 12 minutes talking about how you met the things that you've invested your money in. I'm not kidding. Barb and I are blessed enough to go to a lot of different meetings, whether it be for personal education. We love to scuba. Travel is probably our favorite mutual hobby. We wind up in a lot of places, inside of church, outside of church, talking to people. And that's one of those questions. How in the world did you meet? And I think it is really, really important that you understand, and if you're taking notes, you can write this down. It's one of those, I don't know, I'm not Jethro Gibbs on NCIS. I don't have 72 rules, but I do have some, and one of those is I date my stocks. I married my wife, but I only date my stocks, and I think it's important to understand that. People get caught up into what I believe are some very, very dangerous misconceptions. I've heard brokers say, if you don't sell it, you never lost any money. Well, ladies and gentlemen, that to me goes into pure laziness, lack of understanding of what's really happening. There are times when we need to sell. Not everything that we touch at the Financial Enhancement Group turns to gold. Now, we have a process where we want to get on base more than we want to strike out. We want to be able to score runs, not hit home runs. We're not looking at IPOs that try to make people rich. We want to buy things that we can hold for an extended period of time. And as Forrest Gump said, there's a fruit company, for instance, that we've owned since 2006. We're still long. That means we still own it, that we've had since 2006, 16, 17 years later. The intention is not to buy and have to resell all the time. But again, let's not get caught into preconceived notions. So the way I make every decision financially is through 3 different filters. Now, one of those is proprietary. You can't use it. It's our risk barometer. So Adam Harder is one of my partners. He's our chief investment officer, a CFA. His job is to take in the fundamentals of what's going on inside of the market. Andrew Thrasher is a chartered market technician, a good graduate of Purdue University, one of my students many, many years ago, been with Financial Enhancement Group for more than 10 years. He's a portfolio manager, but his job is to look at the technicals of what's going on inside of the market. The two of them, using a proprietary system, have put together a risk barometer. So before I make any investment decisions, I want to know what it looks like. I love golf. In fact, next week, you're going to hear a whole golf program here on your Retirement Playbook. I'm going to take the analogies of my golf game, that's scary, to the financial world. But that's for next week. In the meantime, that risk barometer is just like the Weather Channel. It's not always right. It can say that it's got a 50% chance of raining, and Barb and I can look out the window and it's pouring down rain right now. But what we're going to try to do is to get an idea of what's going on. Is the market more poised for solid uptrends, just neutral, where it just does what it normally does, or is it going down? And we use that risk barometer based on season, based on fundamentals, based on sector allocations. And if you want to know more of that, I would strongly encourage you to go to our website at yourlifeafterwork.com. You can get signed up for our market carver, where we'll give you a 7 to 9 minute video every week that talks about what's going on in the risk barometer and how we see the market. The second filter, then, is what we call the fiduciary focus. I'm a fiduciary, and odds are, if you're listening to this show, you're your own fiduciary. Well, it could be us. We actually have an awful lot of people that we take care of who listen to this program on an every week, and I certainly appreciate that in your comments. But that fiduciary focus, there's 4 things that myself or Aaron Rayum, our Director of Financial Planning, when we wake up in the morning, here's the things that we have to focus on. It's risk and volatility. That's 1. Fees and expenses are number 2. 3 are taxes, both today and tomorrow. And 4th is the real return. The third filter is what we call the family focus process. That's our trademark process that we have that's made up of the 5 critical elements. Your Life After Work, the annual tax plan, the investment playbook, Life Happens, the good, bad, and ugly of life, and a legacy plan. So we want to make sure that all 5 of those areas are covered. Now that middle filter, there is a good chance you're serving as your own fiduciary. That means at the end of the day, if you're working with somebody who gets paid commissions or is a broker, at the end of the day, you're responsible for saying yay or nay. They make good offerings. They may be good ideas. They may be bad ideas. Remember, having a securities license doesn't mean they're good at their job. It means they could pass a test. That's the same thing I would tell you for my team. Having a CFP, a Certified Financial Planner designation, does not mean that I'm still really, really good at doing what I do. I know a lot of CFPs, and we're not all created equal, but at least we've had an education that is broad-based. And I do believe very, very fundamentally in education in whatever it is, whatever position you're in. It's why we have proficiency exams for our financial planning team. Everybody goes through, and the planning team coordinates and works together. So back to how did you meet? So I've got this thing in my portfolio. And one of the things that I've been told forever is if I don't sell it, I didn't lose any money. Well, ladies and gentlemen, let's think about that. What I want to look at is how something is performing relative to its peers, right? So let's say it's a company that's in the financial world. I want to compare it to the S&P 500. I want to compare it to other companies that are within the financial services sector, just to understand relatively how it's performing against the overall market, but also against other companies that are in the financial services world, right? That gives me a little bit of a contrast of what's going on. Secondly, remember I told you I go to that risk barometer first. Am I looking to trim my portfolio? Am I looking to raise a little bit of cash? You should never, in my opinion, be all cash or all invested, ever, right? But there are periods of time when we have more equity, and there are periods of time we have less equity, again, depending on that risk barometer, which you can get off of the market carver if you pay attention to it and listen every week. But when I look at that, when I'm going to go to sell or raise cash, I'm not worried about whether I'm making money or losing money in a position, and I'm not worried about the cost of trading. The cost of trading in our case is zero. We have none anymore with our contract that we have at TD Ameritrade. And you may have to pay a little bit of commission, but a lot of things that come out of people's mindsets really were established years ago. I got into this industry 2 weeks before the crash in 1987. It literally cost $300 to make a stock trade. If you were going to sell 100 shares of stock, it was $300. Today it's free. A lot's changed over the last 35 years of my career, and it's changed in your life too. One of the things you want to do is make sure you do not have any conceptions from the past or any, I've already thought about this, I've already checked it off, and not been able to take in new data, new information to be able to make a decision. So I don't want to hold it just because of fees or expenses of selling it. But I do care about the tax implication, right? So I bought it. Now in an IRA, obviously this is immaterial. But if I bought it in my trust account or a joint account or even in your own name, has it gone up from what I paid for it? What you paid for it we call basis. Has it gone up in value? Has it gone down in value? If it's gone up in value and you sell it, have you owned it longer than 1 year? Because that's going to be the difference between a long-term capital gain and a short-term capital gain. The second thing then is to remember if the market were go down in value, that's called a capital loss. And you can deduct that capital loss, again, not in an IRA, but you can deduct that loss off your tax return. We even harvest losses intentionally. Yes, you heard me right. Near the end of the year, we intentionally, for you, if we're serving as your fiduciary, go out and look for losses to be able to amplify your tax return. We want to get the most tax-efficient return that we can every year. See, unlike the market that goes up and down every year, your tax return is a one-hit wonder. It's a one-hit wonder. Now, keep in mind as I talk about this with all things, right? Your situation is unique. That's the way God made you. Even I don't care if you have a twin sibling that has a similar career that married another sibling. You still have different views, different perspectives, and that's why it's important to understand your financial vision and your journey. But when we look at this in general, you need professional guidance for your unique situation. This is just general stuff, ideas, education that you can take and apply. But please work with a professional to understand how some of this stuff can really impact you, because there can be little things over here that can change the nature of the beast. But the buy and hold, I'm keeping my stock because if I sell it, that means I recognize losing money. That isn't all bad. Things do change. But just never go to all cash or to all stock. So yes, I did indeed marry my wife. And it's okay for me to talk about the last 35 years of marriage. It's not okay for me to talk about the fruit company and that I own it today because I bought it in 2006. Now, that said, there is a huge amount of capital gains. So that clearly comes into that conversation. when you're looking at your portfolio and something has changed in your risk barometer, however you measure success and you determine what percentage of your money you want allocated into different places, right? When you go to make changes inside of your portfolio, you are going to want to look and say, okay, is this going to create a tax capital gain, or is it going to create a loss? And you'll hear people say, hey, let the taxes take care of themselves. Just sell what you need to sell. Well, ladies and gentlemen, I've done this for a long time. I'm able to look at an awful lot of returns. And I will tell you, as a money manager professionally, more than $600 million that we take care of for more than 1,100 families, if taxes didn't matter, we would throw them out the window, but they do matter. They do show up on your return, and they are a substantial part of your financial journey. The IRS is involved with us every step of the way. We have to make sense in all four of those areas: risk and volatility, fees and expenses, taxes today and tomorrow, and real return, real simply meaning the inflation side. So when you're looking at your portfolio and you're making decisions, you have to look and say, what has it done for me so far? That's from the tax side. What is it doing for me right now? That's the risk and volatility side. And what do you expect for it to do for your financial journey coming up? Then you can decide what you either add to if you have extra money or what you trim. Hey, if you want us to help you with this, just go to yourlifeafterwork.com or call us at 800-928-4001. Get signed up for a Next Steps meeting. We're more than happy to sit down and have that conversation with you about your situation, where we can bring in all the important details. Again, that's yourlifeafterwork.com or 800-928-4001. What is this market carver thing you speak of? Well, ladies and gentlemen, if you're not having fun on this show, try a little harder. I do try to make money as fun as I can, and once upon a time, I even had a cooking show. So think Cleaver, a very large guy. Yes, I broke the rule of finance. I gave away my health to get wealth. And now, like everybody else, I'm trying to invest to get my health back. So far, so good, it's working. But the market carver is our version of what's going on in the crazy equity market and how to divide it up. Do you buy stocks? Do you buy bonds? Do you have cash? What do? We show you that on the Market Carver, and you can go to yourlifeafterwork.com. Get signed up for that. It's free information. We are more than happy to share it, and it talks about our proprietary indicator, the risk barometer, and how we use it for you in your financial plan. Again, yourlifeafterwork.com, 800-928-4001. Welcome to your Retirement Playbook, and this is my retirement tax book, if you will. That's right. You're getting ready to hear about Ed Slott, the IRA group, and things you need to consider about tax planning for your future. The difference between tax deferral and tax delayment, tax-free and waiting to pay the IRS with their rules in the future. Lots of things we need to talk about when I go to the Ed Slott Group, myself, Aaron Rayum, the Director of Financial Planning, a few other planners from here in Indiana, but a little over 400 of us around from the United States get together twice a year. We sit down for 3 days, and we go over, these are just changes, ladies and gentlemen, to the tax code, private letter rulings, things that we need to consider. May 12th and 13th. Through the 13th, I was in Missouri and Kansas City, sitting down with Aaron and Ed Slott and Jeff Levine and a few other people where we were going over some of the things that were on the tax codes. And they're very, very important. When you look at that filter that I talk about a lot, the fiduciary focus, if you will, remember the third thing is that annual tax planning. That's what has to happen on a year-by-year basis that you look at. And there is a difference between planning and preparation. Tax preparation is what my CPAs do. So I use Huth Thompson up in Lafayette. We've had a long-standing partnership with them, many mutual relationships. They do all of our corporate accounting. Ben Smith is the president of Estep Doctor and Company in Anderson and Muncie. He does my personal return in terms of they do the tax reporting. Having a good CPA is absolutely critical. Tax planning has to be done before the end of the year. And ladies and gentlemen, what I have found is most people don't get around to that tax planning. They do what sounds good today. They do what feels good today, but they don't necessarily do what makes sense for their financial journey. And different people have different perspectives over taxes. I will tell you that I had when we moved to our last house in Anderson, we were there for over 20 years. I live in Anderson, by the way, for those of you who don't know, Anderson, Indiana. And um, we would have conversations over how this tax stuff worked and who had the best year and who had the worst year. And my next door doctor was an oncologist. And I always thought he had the worst job of the world as a cancer surgeon until 2008. And he said, you know what, Joe, I think you may have the worst job this year, getting to talk to people about the Great Recession and the things that were going on. And in everything, people's focus totally in 2008 and 2009, and similar to here in 2022, was risk and volatility. The taxes totally went out of the regard. It just, don't worry about that. Worry about what's happening in the market. And folks, I will always tell you that, when a doctor tells you that you have cancer, or when I tell you that there's economic problems, the calendar doesn't matter. Cancer doesn't care about a calendar any more than the market cares about a calendar. Now, there's different periods of time in the year where markets tend to do better, but your taxes are one of those things that's entirely different. It starts January 1st, it ends December 31st every single year. There are very few things you can do up till April 15th, like IRA contributions, but Roth conversions, itemized deductions, charitable gifting, any of those things that you look at, you've got to do before the end of the year. And in my experience, we collaborate with a lot of CPA firms. We don't just cooperate. Cooperate is I tell somebody to do something or they tell me to do it, and we just do it. Collaboration is where we have meaningful conversation and discussion going, is this a good idea or not a good idea? And we have those with people every single year. That's what we do with this. It's not all white and or black and white when it comes to the tax code, especially Secure Act 2.0. One of the things that you're going to find, and there was an article, it was either in Barron's or the Wall Street Journal, but essentially it asked Ed Slott the question, a particular tax question, and the response was, we don't know. It's unclear. The IRS has not clarified the message, and whoever the author was reported, if Ed Slott doesn't know, nobody knows, and that's really the truth. Some of this stuff is confusing. Some of it you can figure out. Some of it you can't. What you can't ever do is pass on tax planning. It has to happen by the end of the year. So my team, for the families that we serve, always sends out a letter. It comes out sometime in the middle of September. And starting October through the end of the year, we do nothing but tax planning meetings. And that questionnaire is essentially going to ask, has anything changed in your life? We know about your investments. We know about your portfolio. We've got all of that. But is there anything changed in your life? A marriage, a death, a birth, a divorce, an inheritance, a job change? Did you give extra money to a charity this year that you don't normally give? Did you sell a house? Was there an investment that you had that you sold at a loss or a gain? We're looking for those kind of things. And then, of course, we look for the date changes. Did you reach any of those magical changes that the IRS hits you with? But I've been going over the conversation that this journalist had with Ed Slott, The New Retirement Savings Time Bomb. It's a book that Ed wrote a few years ago. He's one of the #1 fundraisers on PBS and provides that book for people who listen to the show and make a contribution. But it's a good book. Again, it's called The Retirement Savings Time Bomb. And these were some of the questions that were in it that the author wanted more clarification on. So I thought I would go in there and hit you with one of the big ones. Here's the question. Talk about a loaded one. How do we know Congress won't change their minds again in the future? Well, Ed's answer. These days, the #1 question people ask me is, can I trust the government to keep their word that these will be the rules? My answer, of course not. Fact is, Congress can change the rules again anytime. There's an old saying in accounting, the tax code is written in pencil. And boy, is that the truth. I will tell you that all tax code is social policy, meaning that when they write the tax code, the politicians who are in office are trying to get us to do things. There's a reason you can deduct mortgage interest, but you can't deduct auto interest, for instance. It's all tax policy is social policy, but it's all based on the people that are in there at the time. Remember, when we say something sunsets, that means that the Congress has to vote to keep it in, and when it's permanent, it means they have to vote to change it. So the current tax code that we're in today is sunsetting at the end of 2025. It's not permanent, meaning they would have to vote to keep it in. So given the uncertainty, this is back to Ed, given the uncertainty, it's important to keep in mind which direction tax rates are headed so you can plan accordingly. Ed's words, not mine, hint, not down. Now, this is where it really becomes confusing. And this is that academic part of me from the 7 years that I taught at Purdue. I told my students, forget two sides of your mouth. I talk out of three. I talk out of the academic side. I was a professor at Purdue University where I taught financial planning for 7 years. When you deal with the world of academia, they don't deal with you uniquely. What they deal with is the average. And if you look at most of the white papers that are written that I had to study and even to a degree taught to, they were talking about a median income of people that made $40,000 a year. And I think it was $44,000. And that's a joint household. Ladies and gentlemen, there are very few of you that have a joint income of $44,000, unless you're already retired, who are taking the time to listen to this program. You are unique. You're not average. So a lot of the stuff that we talk about academically and that you see in white papers and journalists report on probably doesn't apply to you. The second side is I am a certified financial planner. I have been for over 25 years. And so figuring out and talking about what we say in the financial planning world is a little bit different. That escalates it a little bit, but it's still not your unique journey until I can sit you down in the office and have a meaningful conversation about your unique situation. The third point is, or the third side of my mouth is I've done this for 35 years. I'm the Rodney Dangerfield and back to school of, you forgot about this and you forgot about that. If you haven't seen that movie, it's a great show, by the way, back in the 80s, Back to School, Rodney Dangerfield. And if you're too young to know that, I give. Somebody on my team said the other day, who in the world is Rodney Dangerfield? That's just scary. But anyhow, back to this. The things that I've seen in 35 years are sometimes very, very different than what I know as a CFP and what I know academically, because people behave in very, very different areas than the way they're supposed to in a vacuum. So when you look at tax rates, are they going up or are they going down? I can't get into that argument. A federal judge said it was illegal for us to actually tell you the tax rates are going higher. What I will tell you is academically, they tell people that when you retire, that your tax rates typically go down. My experience for those of you watching the show, the 35 years that I've done this, for those of you watching or listening to the show, is very rarely does your tax rate actually go down. Now, you don't have to pay Social Security tax anymore, but keep in mind, when you put $1 into an IRA or into a 401k, you're still paying the FICA and FUTA taxes. You're not deferring that at all. So when you take that money out, you don't have to pay the Social Security tax. You don't have to pay FICA and FUTA when you're taking those withdrawals. You're still subject to the marginal tax rate at that point in time today. So if somebody asks me, are the tax rates going up right now because the tax set sunsets December 31st of 2025, and for most people it's higher, I would say yes, I will assure you at that amount of income, your tax rate is going to go higher. So now you get into the next argument. Do you believe your tax rate will be lower when you retire? If you are one of those people who spends a small amount of what you make, you have not put a lot of money in tax-deferred planning, like IRAs and 401ks, then it is conceivable that you would be at a lower tax rate when you retire. But the bottom line is most people I know who don't spend all they make put a bunch of money in tax-deferred plans because it feels good today, and they're not paying the taxes on that money today under the hopes that they're going to be able to have a lower tax rate in the future. Well, let's just pretend the tax rate stays static and you continue to put that money inside of that 401k or the IRA or the 403b if you're a teacher or a nurse or in the not-for-profit world. That money still has to come back out. The IRS still gets their pound of flesh, and it's going to be at whatever the tax rates happen to be in the future. So when you have that growth on that money, there is a minimum amount that you have to pull out called a required minimum distribution. That amount of money adds up, and it will steal your retirement. Ladies and gentlemen, in 35 years, I have never seen anything separate somebody from the retirement they deserve like the Internal Revenue Service. The tax code is not your friend, but it is a rule book. We have to use it, understand it today, and make the right decisions for your financial journey. What are your next steps? Yeah, that's what we call it at the Financial Enhancement Group, the Next Steps program. When you come in, we want to make sure that we're able to sit down and provide value for you. If you bring in the documents we request, we'll give you 90 minutes of our time, complimentary. We will go over things you need to consider today, things you're going to probably want to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it into writing. Get signed up for your Next Steps meeting. You've got nothing to lose. Go to yourlifeafterwork.com or call us at 800-928-4001. Should you cancel your life insurance policy? There are many things you consider when you look at a life insurance policy, things you should consider before you buy it, things you consider when you make the premium payment, and things to consider before you cancel it. We're going to discuss that on the next 12 minutes of your Retirement Playbook. Life insurance is an interesting thing. They call it permanent. And yet the average person who buys a permanent policy buys 7 of them over the course of their lifetime. In fact, the people who buy permanent life insurance, you still have less than 1 in 5 people who die with one of those policies in force. So what in the world happened? How in the world could I buy a permanent insurance policy and die with no policy? And if I bought a permanent policy, how did I go through 7 of them? Well, it's an interesting thing. I'm going to actually, without a whiteboard, try to teach you a little bit about life insurance. Now, the first thing you need to understand is all life insurance is term insurance. It's what's called ART, annual renewable term. So every year, I'm 55 this year, every year there is a life expectancy table. And that life expectancy table is going to say at 55, and they're not just talking about Joe Clark of Anderson, Indiana, they're talking about all of the people that are 55 in the United States of America, and many times even more than that. But they're looking at all of the people that are 55 and saying, based on what we know, this is the probability of when your life will end. And, you know, it could be 84 and 4 months. Let's just call it 84 and a half, just for giggles, right? So at 84 and a half, the average 55-year-old in the United States is going to die. What does average mean? Average does not mean 50% necessarily, but it means that there's going to be some people, that I'm one of them. It means some people are going to die before that at 55, or they're going to die at 58, or they're 65, and there's going to be some of those folks that live to be 100. But when you look at all of those and you average them together, the average one of us, if the actuarial tables were right, are going to pass away at 84 and a half. Now, it is very, very important that you understand on your financial journey, you are unique. Right? So when you look at life expectancy tables, whether it's Social Security or life insurance, you're competing with people who were, by definition, not necessarily at dentists every 6 months like you probably were, had access to health care like you probably did, and did things that were not normally harmful for your body for an extended period of time. But nonetheless, at 55, there is a cost of insurance for me today. Now, the insurance companies will go in and will add an extra expense to that if you have bad health problems or what they call pre-existing conditions. If you have it at work, there is no extra charge because it's a group policy. What does that mean? Well, if it's a group policy, usually 1 times your annual income up to $50,000 is free. It's a group policy. So if you're in bad health, that's a good deal for you because they put it all together. Again, its own little actuarial pool. But if you're in great health, always take the free insurance your employer provides. But the chances are you can probably buy annual renewable term or a term insurance policy cheaper in your own name than you would in the other. So term is not permanent. But term is part of every life insurance policy. That's how it is priced. The rest of it is how it's packaged and how it's sold. So you can buy annual renewable term insurance where the price of the term insurance literally goes up every year because you're closer to life expectancy. It's one of those things most of us don't want to try out, quite frankly. You know, I'll keep paying the term cost. Barb and my family are protected. The Financial Enhancement Group's protected. I hope we don't need it and that I'm wasting the premium payment. I tend to buy my life insurance in 10-year increments, or what's called 10-year term insurance. I don't see the point in buying 20. I don't know what the next 5 year holds for the tax code or things that are going on. I want to buy something that gives me the next 10 years of a forecast of an idea that's what's coming. And every 3 years, I adjust. As long as my health stays in the same procedure or the same area, I'm able to buy another 10-year term policy going forward. If, however, my health were to decline, I can convert that to a permanent policy if I so choose. But I look at it in 10-year increments, not 20 years. If you buy it in 20 years, it's going to be the same premium for 20 years, but you're going to pay more the first 10 than you would if you just bought a 10-year level term policy. Now, why in the world do people go through so many different policies? And the answer really is because insurance policies are usually sold rather than bought. Now, what's that mean? Well, rarely does somebody call up a life insurance agent and say, hey, I'm in the market to buy $500,000 worth of whole life insurance. Would you like to come sell it to me? No, that's not what happens. Usually it's somebody who says, hey, I know this person, they referred me to you. I'd like to stop by and drop off a little information. And they sit down at your kitchen table and explain to you why you need to buy life insurance to protect your family from the unexpected. I get it. I understand it. It's a necessary thing, but you have to understand the difference between sold and bought. And you've got a very, very complicated thing that is working in front of you. So let's just pretend that you've got a whole life insurance policy. That is made up of what's called a face amount, if you will. That's the death benefit. And then you've got a column that's the guaranteed cash value. Now, you can always trade the death benefit for the guaranteed cash value, or you can die. You're going to lose the guaranteed cash value, but your family's going to get the death benefit. You never get both of those columns in a whole life policy. You get one or the other. Guaranteed cash value or the death benefit. This is what the insurance company is willing to pay you back, the guaranteed cash value, to buy your face amount and to eliminate their liability for your death benefit. Then there's a third column, and that is one of two things. It's either dividends, which have been defined, by the way, as a return of overcharged premiums. That's why a dividend from a life insurance policy is not taxable, where a dividend from a stock is taxable. A dividend from a life insurance policy is not taxable. However, the interest earned on those dividends after they're paid is taxable. So you will get a 1099 from your life insurance provider if you have dividends that have been paid. And the 1099 is not on the dividend, but it's on the interest that you've earned. So that cash value is building. So remember, you get the face amount, the death benefit, or the guaranteed cash value, but you always get the dividends. Those are yours. Now, you have the ability to trade those in, if you like, for what's called a paid-up addition. PUA, you may see on your statement. Paid-up addition means you bought more life insurance, so it's not a dividend anymore. It's not earning interest, and you won't get a 1099. It still has a cash value, but that cash value will be lesser than what a dividend would be if you had dividends accumulating, but your death benefit will rise. So if you truly want it as a death benefit policy, and you don't want to pay taxes along the way, and you're buying a whole life contract, you probably want the paid up additions. If you want more cash accumulation, or what they call a vanishing premium, then you're going to want to use dividends. So what in the world is the vanishing premium? And this is how insurance policies are sold. Based on our forecast today, they got this nice little printout that talks about interest rates that we're not earning today, we didn't earn yesterday, but people somehow or another think we're going to be here tomorrow. But based on the dividend forecast and current interest rates, in 12 years, you will have enough dividends that the dividend will be able to pay your annual premium, and you can quit paying premiums. That's what when people talk about a vanishing premium or a policy paid off. Very rarely is that real, by the way, a policy being paid off. It's almost always where the dividend or the growth on the dividends is enough to allegedly pay the premium into the future. It does happen. Sometimes it happens later than what's anticipated, but it typically does happen. So along the way, the insurance agent, when they sell a life insurance policy, gets paid the extreme majority of their money to sell you the policy up front. They get a little bit of money, a trickle, what they call renewals, that comes in from the policy that's there. So you expect and deserve, in our opinion, that's why the Financial Enhancement Group has its policy in terms of doing family updates on an annual basis. When you look at that life insurance policy, you anticipate that they're going to come back, visit, and do for you a review of your insurance existing policies and needs. The problem is the agent is not getting paid to be there other than the renewals they would get whether they showed up or not. So it's in their best interest to actually be able to talk to new people or to get you to buy a new policy. And this is why people wind up with 7 different policies. It's very normal for an insurance agent to look at those dividends that's inside of the policy. And please don't, all life insurance agents are not evil people. They're not bad people. Sometimes there's reasons to do this. You just need to understand what it is you're trading or giving up in order to do it. But many times they will look at that dividend or the cash value that's in there and show you how to take it to be able to use along with the premium payment that you're currently making, or maybe even get rid of the premium and buy a policy where you can take that money and put it in a large lump sum. If they start using terminology called a 1035, that's a tax exchange, where you can move money from here to here without paying any taxes or recognizing any taxes. That could be one of the things that are happening. And in my opinion, in experience, that's why we see so many people wind up with so many policies. Please do not take this as life insurance agents are bad people, or that there's never a reason to do this. Sometimes there are. I just want you to be educated and understand what's transpiring inside of there. You should never cancel a life insurance policy without making a phone call. My team is very, very well aware of this. You always want to know what the basis is inside of the life insurance policy. The basis is typically the premiums that you've paid over the years, less any money that you may have pulled out or borrowed out or whatever. It's critical to understand that. Because you will get a 1099 if you have a gain in it. And that money that comes out of a life insurance policy, once it's surrendered, once you've canceled it, is taxed at your marginal rate. So we've seen people that have $100,000, $200,000, $300,000 of marginal gain. They canceled a policy. They didn't think they needed it anymore. They didn't talk to their CPA. They got bad advice, a host of different reasons. They cancel the policy. Here comes the 1099, and there's no way to put that jack back in the box. It's done once it is done. So you always want to ask the questions. Again, I would tell you to bring up the filter. First, look at your financial journey, and then you want to talk about risk and volatility, fees and expenses, taxes today and tomorrow, and real return. Does this life insurance policy make sense for you, or does it not? Lots of questions. Of course, we have a checklist if you want it at yourlifeafterwork.com, or call us at 800-928-4001. James Clear, author of Atomic Habits, makes it very, very clear that success is never dependent upon one thing, but failure can be. And that is so true in the financial world. It's so easy for us to fix our heads on risk or volatility, or fees or expenses, or taxes, or inflation, or what we call real return in the financial world. But ladies and gentlemen, they all matter. And it is important that you have a financial process that gives you a lens that forces you to look through all 4 of those simultaneously, to not overweight any one of them. That's what we call the fiduciary focus. And that is our promise to you at the Financial Enhancement Group. Our job is to treat your money as if it were our money and we were in a similar situation. Go to yourlifeafterwork.com or call us at 800-928-4001. Get signed up for your Next Steps meeting. How did you meet your investments from a tax perspective? Yes, in many cases, you get to make a tax decision. Do you want to pay taxes on the money today, or do you want to pay taxes in the future? Pay attention to the next segment of your Retirement Playbook, and we will talk about which tax strategy you should employ. This is from an interview that was done by my buddy Ed Slott. I worked with Ed for, it's hard for me to say this, the last 17 years. Was one of the founding members of the IRA advisor group that Ed created, and was on his board for over a decade. He wrote a book called The Retirement Guide. Hold on. I got to get this right. Retirement Savings Time Bomb. This was an interview that he did over where an author set him down and wanted some clarification. And I think this is very, very important. When you look at the fiduciary focus and you understand those things, the risk and volatility, the fees and expenses, the taxes today and tomorrow, and the real return, And remember, whenever we say real, we're just referring to inflation, which is now on everybody's headlights. Now that they go to the gas station and they think about it on a regular basis, and you'd be amazed the last 10 years, people ignored inflation. In every one of our meetings, I would put it on the board and bring it up, and people would say, oh, Joe, inflation. Inflation's real, ladies and gentlemen, and so is risk and volatility, and so are fees and expenses, and so are taxes both today and tomorrow. We really have to look at them over the journey. But here's the question that Ed was asked. The Tax Cuts and Jobs Act, the TCJA, was ushered in at historically low rates. So that's what happened at the end of 2017 when you hear that. And that's the provision that went effective January 1st of 2018, but it sunsets December 31st of 2025. That means if you can't get 60 senators to agree, and I'm not sure you could get 60 to agree the sky was blue or the ground was brown, right, or the grass was green, whatever illustration you want to use, if they don't agree to change the code, then everything reverts back to how it was in 2017. So you go to the 10% bracket, then 15, whereas today it's 10 and then 12. You go back up to the 39.6 versus the 37 if you're on the top end of the tax code. The estate tax code reverts back. Lots and lots of changes that are there. But it says with that historically low rates, while these tax rates are still available, this is a great question from the journalist. What strategic money moves should Americans consider? So the theme of this whole show really has been, how did you meet, right? I started off the introduction by telling you that people ask Barb and I, after 34 years of marriage, how did you meet? It seems to be the standard question. I always ask people that when I meet with their investments. You know, how did you meet this stock? Or how did you meet this 401k or this IRA or this SEP program? How in the world did it wind up in your portfolio? Well, if one of those considerations is not the tax treatment that you want to use and how you anticipate paying taxes on it in the future, then you've really not thought about this as thoroughly as you would like. I'm not a real fan of the term, I will tell you. Patrick Lencioni is one of my favorite podcasts. I hope you listen to this program. Obviously, you are right now. But I listened to At the Table with Pat Lencioni, and one of the talks that he had here recently was the patron saint of ignorance. And ignorance does not mean stupid. Ignorance means simply unaware. And I think that really is what happens, even though I don't like the word ignorant being used. But I think that really is what happens. A lot of us make financial decisions without really understanding the complexity of the decision. Right? So you've got money and you go to your work and the employer says you can save, if you're over 50, $27,000 in a 401k, and you go, phew, that's a lot of money, right? And so you decide that you're going to save 10% or 15% or whatever it is, but a different amount than that maximum amount that you can save. Based on what? What were you thinking in that what filter did you use to come up with the amount that you were going to save? For most of us, it's two numbers. It's how much can we afford to not bring home because we're already spending it today, and two is how much will the IRS let me put in, right? They're both very, very simple questions. How much can we afford, or what is the maximum we can put in? I'm going to argue that there are more things that need to be involved in that conversation. Next week, we're going to talk about the golf game. And you can walk up and you can say you've got 14 clubs and I'm just going to swing this club, or you can have a reason as to why you use that club. Every time you have an extra dollar, I want you to be able to look at that dollar and try to determine where it should be invested. Should it be in an account that you have access to? Should it be an account that's tax deferred where you don't care about the age and you want to pay taxes on it in the future? Should it be an account where you pay the taxes today but it's a Roth IRA? You may be limited to getting some of it back if it's in a 401k. If it's a Roth IRA, you have access to the contribution all the time. But what is the purpose? I want your checklist to grow, not contract. I do believe in simplicity, not complexity. But at the same time, you need to have a thorough conversation with yourself when you have money. When you make the decision to save, whether it's in a 401k or a 403b, keep in mind every decision that you make is a counter choice for what you could be doing today. I always tell people, y'all have done the heavy lifting. If you're listening to the show, you've already saved and accumulated money. Now it's our turn to be able to help you get the most out of that money. When you call the Financial Enhancement Group, that's our job. But while you're putting money in, every dollar that you choose to save is a dollar you're saying no to Disney, or no to a nicer car, or no to a bigger house, or no to going out to eat. They all have costs. They all have a price to them. Every decision that we make has either a current consequence or a delayed consequence. I think it was Zig Ziglar that said you will always either pay the price of discipline today or the price of regret later on. And that's really what we're about here on the show, is helping you reduce financial regrets. But I don't want you to save so much today that you give up life without understanding why. And when you do give up life, when you do say, I'm not going to spend this, I'm going to save it, I want to make sure that it goes in the right category, the right place. So again, the question is, with tax rates low right now, what should Americans consider? Here's Ed's answer. It's all about moving from forever taxed to never taxed and paying down the large debt hidden within retirement accounts. Well, what does that mean? That means that whatever dollar you tax defer, the IRS is waiting in the background, just kind of like monsters in the closet, waiting in the background to get their pound of flesh. And somebody will pay it. You have three choices with IRA money currently, or tax deferred money currently. One is you pull it out and you use it as income, which is what most people wind up doing as a required minimum distribution. Well, you'll pay the IRS the tax rates based on the current rules and the current tax code at the time of retirement, not today. In other words, you're trusting the IRS that the tax environment in the future will be equal to or better for you than where it is today. I would not go there. I can take you through the Secure Act, which was anything but secure for retirees, and show you what it did to people. But the idea of never taxed is what we call the Roth contribution apart. That means you pay the taxes today, but you don't have to pay the taxes in the future. There's two strategic moves, Ed says, to be able to do this. One, you contribute or convert your conditional IRA to a Roth IRA if you're able. So there is no AGI restriction, adjusted gross income restriction. If you have an existing IRA, and I think the oldest person I've done this for was 92 or 93 years old, so there's no age requirement. You don't have to have income this year. You can take money out of an existing IRA and convert it to a Roth IRA at any age. You do that, you pay the taxes on it today, but you never have to pay the taxes on it in the future. Now, people ask me, Joe, why would you do this? Well, think about this scenario. All of a sudden, I'm 85 and I've got a huge tax bill, or a huge medical bill, rather, that I'm able to deduct on my return, but I have no income to be able to offset it. I may do a Roth conversion, take money intentionally out of my IRA so that I can use that and convert it to a Roth today, even though I'm 85 years old. Convert it to a Roth, use the tax consequence of the conversion, you have to pay the taxes, to be offset by the loss. One of those things that you really might want to consider. I told you there were three considerations, right? So you can choose to pay the taxes today, or defer the taxes today and put it in an IRA or a 401k. When you pull it out, you're going to pay taxes based on the code then. The second choice you have is to pay the taxes today and put it into a Roth where you never have to pay the taxes when the money comes out. And the third is, again, under the current code, you can give it to a charitable entity at your death or at a particular age under what's called a qualified charitable distribution, or QCD. But again, those are under the current rules. You got to be very, very, very careful. So when we talk about doing a Roth contribution, you can be any age, but your adjusted gross income has to be below a certain level. And if you're married, it's higher. It's a joint, but it still has to be below a certain level. And you can have the right to make that contribution into a Roth IRA. You're going to pay the taxes on it, but you don't have to pay the taxes on it when you pull the money out and you have access to it. If it's a Roth 401k, again, you're going to have to pay the taxes on it right now, but there is no AGI restriction. It doesn't matter what other plans you have or your spouse's income. A lot of people miscommunicate or confuse IRA contributions and Roth IRA contributions. If you have a 401k at work and your income is not even really that high, you may not be eligible to contribute to a tax-deferred IRA. You can still contribute to a Roth IRA where the income range is much, much higher than it is for a taxable IRA. Again, presuming you have some of the other income restrictions that hold those down. So just different things to consider. But I'm telling you, one of the biggest things for your parents or you to use based on your age is recognizing intentionally money out of tax-deferred programs in order to get them on your tax return when your tax rate is lower because of annual situations, whether they be medical or charitable gifts or things just happening. Do not let the tax code just happen to you. You want to be proactive. You want to understand it's a journey that goes from January 1st to December 31st, and that one's done. It's a one-hit wonder. When you're looking at your planning and your financial journey, understand what taxes are going to look like for an extended period of time and make the best decisions you can for your whole journey. So how did you meet? Yeah, I'm talking about your loved one, but I really am talking about your investments. And I think it's important you sit down with your spouse if you're both engaged in this, and if you're not, I pray that you will be. But when you sit down and you have this conversation, you really want to write that fiduciary focus on a paper, and you want to think about it in terms of risk and volatility. What's risk? Risk is that it goes up and down, and it may not be worth what it was yesterday, even though you believe it'll be worth more in the future. There's that risk of volatility of it going up and down along the way. Real risk is simply not getting your money back, if you will, but that's a whole nother story. Risk and volatility. The second column are fees and expenses. What does it cost to add, make changes? What does it cost to get here is absolutely immaterial. What does it cost to get out? That's a different story. When you guys listen to the show, many people will call and say, Joe, I bought this equity indexed annuity. It sounded good at the time. Or I bought this variable annuity. It sounded good at the time. What do I do now? And the answer is many times not just to surrender it. We'll help you with that conversation where we can get little bits of money out over a period of time in the best tax consequences with the least amount of fees and expenses. But what it costs to get in, immaterial. What it costs to get out, very material. The third is the taxes, both today and tomorrow. So we look at your annual tax return, we look at your standard of living, and we try to figure out what your future tax rate is going to be if the tax rate stayed the same. In other words, when you go to retire, your income will drop. What are IRAs and 401ks going to force your income into? That would be one question. And then secondly, what's required for income for your standard of living? And what happens when one of the spouses is gone? Many times people forget that your tax return is married filing jointly, and it gets a whole lot more difficult when that tax rate goes up. Last but not least is inflation. How much does your income have to go up over a period of years, thus driving your tax rate higher simply because of inflation? These are things that we're more than happy to discuss your unique situation. If you go to yourlifeafterwork.com or call us at 800-928-4001, get signed up for a Next Steps meeting. One of our team will sit down with you. We'll go over your information, your unique situation. We'll give you things to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it into writing. Again, it's yourlifeafterwork.com. Go there. We help reduce financial regrets. Have a great week.